Welcome back. You are watching Stock Watch with me, Zinati Guma, and joining me to take your stock-related questions is Ricus Reeders from PSG Hole in Ruimsig and Wayne McCurrie from FNB Wealth and Investments. Do send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. Let's actually get straight into the questions. And one of the most common questions usually are on banks. And here is one, particularly I think on the back of the Capitec results. Can you ask your panel if banks can carry on their rally in 2025? I think this is the beginning of economic growth and they should benefit from this. Give your comments on our four banks, please. Well, I guess was it a Standard Bank, Nedbank, Absa, First Rand, and Capitec? But I guess if they're saying four, then that excludes Capitec. Ricus, your thoughts on the banks?
Yeah, it's a balancing act. Banks tend to do less well in an interest rate environment where interest rates are declining, which is where we are at. But as the viewers said, if there's a positive mood amongst consumers, they want to go and borrow, or money is more affordable when interest rates are low. And if there's positive sentiment, that helps as well, both for business and in the private sector. So the outlook in that respect, I think, is mixed. Someone has to take a look at the valuations of our major banks. I don't think they're extremely expensive, even after the run they've had over the past year or so. So it's not going to be as positive as it has been over the last number of months. But I still don't think it's a bad place to be in.
Okay, not a bad place to be in, but maybe won't see the kind of growth that we have been seeing, but they still will grow. Wayne, on Capitec, I do understand that the viewer said that we should comment on the four, but just on the back of those results where they had a 36% increase in their bottom line, what do you think of their growth going into 2025?
Look, it's going to be incredibly difficult to match that 36%. They can probably still do a lot better than the other major banks, but to match 36% is a very, very difficult task year in and year out. It is in fact impossible to do it, forever. So the earnings growth rate must come down over time. When you look at their last set of results, the ones just before these ones, the earnings wasn't good, relative to the share price. And I started to think, maybe these guys have peaked, but then they literally pulled the cat out the bag again with these results. Look, I agree with Ricus on the main banks. In a rising interest rate environment, the banks' margins get squeezed a little bit. Look, they do a lot of interest rate hedging. Everyone knew this was coming, but your margins still get squeezed and you still get the residual bad debts coming through from the higher interest rates. But ultimately, lower interest rates are good for banks because they will eventually generate volume growth. But most importantly of all, as to why I think the rally can continue and not with the same intensity, is that the ratings are low. You take, my stock pick, we can talk about it now, Standard Bank. This is a 9 price earnings ratio, single-digit price earnings ratio. There's still more upside in that rating going into a good, well, not a good, but a better economic environment. So I think the banks can, in fact, continue their rally.
Yeah. Well, there's a question basically relevant to what is happening right now. We know the escalation in the Middle East tensions. Can you give an indication of which type of shares will react positively and which will react negatively if the Lebanese-Israeli crisis escalates into a full-scale war? Well, I guess that's been the question. Will things actually escalate to a full-scale war? But just Ricus commenting on what we are currently seeing and the risk that the markets are pricing in. Is that something on your radar in terms of the stocks that you're looking at this point?
Yeah, it's very simple in the short term. It's oil and guns. So any weapons manufacturer, US specifically, and if Israel starts attacking Iranian oil installation. That's what the third biggest producer of the market. So that should have an effect on oil prices. I mean, it will go up.
Yeah, yeah, indeed. And on your side, Wayne?
Well, look, we sincerely hope that level heads do prevail here and it doesn't become a major escalation. Look, there's been, unrest going on there for, since 1947, essentially.
Yeah.
So it's not new news. The escalation might be, as heightened it and we all know the history of what's been happening there over the last year. But we sincerely hope that it doesn't escalate. If it does escalate, understand it's bad for all shares, eh? And you might get the odd exception, as Drika says, oil and guns. They might be the odd exception, but it will not be good news for the share market. It will not be good news for the rand. Suppose you could buy the dollar if you wanted to. That'll probably rally in an uncertain environment.
Just on that, we're talking about oil. I'm actually looking for the question now. There was a question on Sasol. Let's talk about that. Actually, Sasol. The viewer's asking about ringing the bell on the bottom for Sasol. Ricus, do you have a bell that you have for ringing the bottom?
I have a downside support level of about 115 rand. So I wouldn't want it to go below that. But taking it broader, if you want to invest in an oil company, whether you are positive oil prices in general or because of what's happening in the Middle East, there are far better offshore counters to buy than Sasol. ExxonMobil, just to give an example, which is in my portfolios.
When we also saw the share price rising, I actually don't know how much that impacted Sasol. What have you made of just that relationship, and if maybe it could signal some sort of bottom, at least in the short term?
Yeah. Look, Sasol is oil and chemicals there. It's not just oil anymore, but obviously a higher oil price will help Sasol. I mean, there's huge risks attached to Sasol. We all know the total catastrophes they've had over the last, decade. I mean, absolute wasted money in buckets. But that's all in the past, and that's probably all in the share price. Because understanding the risk, Sasol looks seriously cheap. I mean, all you've got to do is get a better global environment where chemical prices go up and the oil price goes up. Because the oil price, it's not sustainable in the 70s. Because the oil producing companies just don't get enough to run their countries when the price is there. And hopefully some economic growth will actually push the price up a little bit. So I think taking into account risks, don't put all your money into it. I think Sasol is truly cheap at this sort of price. And just to come back to your actual question, I wish there was someone who rang a bell at the bottom and at the top, by the way.
And at the top. When I actually just want to stick with you because the question is also on the bottom for Amplats, one that you've spoken about a lot.
Yes. Well, look, I mean, clearly I've been wrong on Amplats. I've been bullish on it for a while. But, these platinum shares, you don't have to get much of a rise in the platinum and palladium price for these shares to really perform. So when we look at Amplats, I mean, it's been sitting between, call it that 515 book build was a bit of an abnormality. But it's been sitting essentially between 600 and 700 now since the beginning of the year, just about. These companies, I mean, I can remember no one wanted to touch a platinum share in the late 90s. Then we got the China years. Now, I'm not for a moment saying that the commodity upcycle, which I think is coming, is going to be nearly of the same intensity. But these were the best performing shares in the market, platinum shares, from about 2002 through to 2008. I mean, Amplats can, and this is no exaggeration, Amplats can comfortably, given an economic upcycle, go to 1,500 Rand. It can easily double. It's done it every single time in the past we've had an upcycle. So, I mean, I was obviously wrong here. I'm in way too early.
Okay. But you're still sitting.
I'm still very positive in medium term about this.
Yeah. Yeah, it seems Wayne is basically ignoring the short-term pressures, really bullish still on Amplats, even though maybe he's trying to call a bottom at some point. Ricus, your take on Amplats?
No, I agree with Wayne. Its time will come, I think, not only because of your general commodity cycle, but there's, by the looks of things, from what I read, a shift away from all electric vehicles to more hybrid, and even with hydrogen technology, possibly. I mean, that will also increase the demand for the physical metal. So its time will come. All I'm waiting for is looking at a graph and a technical picture that looks favorable, and the kind of operational gearing you can get out of it with an increase in the PGM metals prices is enormous. And as Wayne said, you can see these things double, not only because of a fundamental increase in value, but also because of a general metal madness that goes along with that kind of move.
All right. Well, gents, let's get into retailer Mr. Price. Is the current Mr. Price share a bit, a bit too heavy, or is there still some upside? Wayne?
Look, there's still upside, I think, in the shares in all of our successful retailers. I mean, obviously, they've run hard on the back of all the, for a change, positive developments in South Africa. I mean, you can hardly believe we're saying they're positive developments in South Africa, but they actually are. So, I mean, this share is up strongly. It's at a fairly high rating by the market, but I think there is upside, but the cheap money's made, yeah.
Okay. All right. Ricus also?
Yeah, I'm very subjective. I've missed the rally in Mr. Price to my own detriment. Yeah, but they've had a beautiful rally. They've actually taken out a previous high that was mid 2021. So that gives an idea how long it's been on a recovery path. But the momentum looks great. Although in the short term, I think it's overbought. But certainly on any pullback, maybe a bad set of results because of the competition they're getting from, Timo and so forth, I would certainly be looking at buying.
So you're eagerly waiting there. All right. Gents, we have quite a lot of questions. Let's get to Cashbuild. Can you give your view on a Cashbuild as a buy at the current price? Wayne, I know that Chantal Marks from FNB has actually picked a Cashbuild for, I think, the last month and a half. But at some point she says maybe she got in a little bit too early. What's your take on Cashbuild?
Well, look, I've got to be very careful about contradicting Chantal because she might beat me up. So I'll have to be very careful. Look, Cashbuild is a good business, but it's a highly cyclical business, and obviously all the players in this market had a wonderful COVID where all the men around their house were sick of being moaned at about the squeaky door and the leaky tap, and they fixed everything because they had the time to do it because they were at home. Then all these companies went through a bit of a lull, and now they are starting to pick up again. And I actually quite like Cashbuild, but we've got to maybe wait a little bit longer for the effect of lower interest rates to start biting, for people to start spending a little bit more. But in this market, it's a very, very good operator, obviously. And I mean, the share price hasn't been catastrophic on Cashbuild either. But yeah, I support it longer term. Surprisingly enough, I mean, obviously there is a lot at the fringes, but the big players in this industry, they've survived an online onslaught. Obviously you can get tools and small things on Temu and all the other players, but if you want a bag of cement, you're still going to go to Cashbuild or Builder's Warehouse or Build It and go and buy that. And so they in actually a reasonable position to weather that online storm. And of course, they've got their own online. So I quite like Cashbuild.
Yeah, it's quite interesting because both Italtal and Cashbuild have been talking about, the big, heavy competition in that space. Ricus, what do you think of the home improvement industry? Well, yeah, counters. And if you are interested, would this be the time when nobody's really looking at them and the numbers are still bad compared to maybe waiting for something to actually filter through to the numbers?
Okay, full disclosure, I bought myself some Cashbuild about 3 months ago. Partly because Old Mutual published a survey amongst their clients, and which asked the question, what are you going to do with your withdrawals resulting from the two-pot system? And I think the third biggest wish list was home improvement. And I thought, okay, that's interesting. And then also longer term, the fact that they've managed to survive the post-COVID slump in the market itself, the way the graph looks at the moment, I think it's at some kind of a bottom. And I think it might really start going price-wise if we get above about the 170, 180 Rand level. So I don't know whether my timing is any good, but I think it's one of those sectors, and specifically a company that is pretty close to a bottom, and as I said, and looking forward, probably not too expensive. So I'm reasonably optimistic about it.
All right, let's get into construction. Avenge. I don't know if this is one that is on your radar, gents. Currently, how will Avenge shareholders benefit if they list McConnell Dow on the ASX? I think they were even talking about a potential listing on the JC as well. Wayne?
Yeah, look, I mean, we all know the disaster that's happened to this industry post-2010. I mean, Avenge at some stage was a huge company with massive cash on the balance sheet. But I mean, clearly, these companies have fallen on tough times. There has been a little bit of a rally in the last short while. In fact, quite a strong rally in the last short while. You will benefit because there'll be a separate listing and there'll be more value unlocked. But it's not a company that I would actually buy for my portfolio.
Yeah. And on your side, because they've also just been doing a lot to really try and turn their prospects around. Ricus?
Yeah, hopefully they can, and we'll have another NAMPAC if you take a look at what that company's done over the past year or so. But what's helping Avenge at the moment has been a rally in that whole sector. If you take a look at what happened, or at what's happened with Wilson Bailey and Robex, it's almost as if Avenge couldn't help but participate in the rally in the building and construction sector. I agree with Wayne, all ships might rise, if the tide comes in, but if you've got a slightly leaking ship like Avenge, it's probably not the best choice for a long-term investment until they prove that they have actually turned the operations in that company around.
Okay. Gents, let us get to a question on Naspers and Prosus. As I try to find it, if I remember correctly, the viewer was asking what is basically the reasoning behind the share buybacks instead of actually just taking that cash and giving the money to shareholders in the form of dividends. Wayne?
Look, it's quite simple. It suits the company and the company's management to rather buy back shares, because you're buying back shares at what you think is a huge discount to your net asset value. So if you buy back those shares, you automatically increase your net asset value. I mean, other than maybe paying a bit of interest or losing a little bit of cash, interest on cash, you have fewer shares to divide the same profit pool, so you get higher earnings per share. So you enhance all of your metrics. Your whole company, your earnings look better, your net asset value, your intrinsic value, these all look better as long as you are right ultimately that the shares are operating at a discount to net asset value. Of course, if you're wrong on that and you're buying shares, you're going to take a hiding. But as long as they're right on that assumption, it suits management, it suits the company's data, it suits the company's financial statements to buy back shares rather than giving the money back as an extra dividend to the shareholders. And management will argue that they are in fact giving you money back because they're pushing up the share price. But of course, that's a tenuous link.
And actually, just a compliment from the viewer, and I'll direct it to you guys. Thank you for an insightful show. I've definitely leveled up my knowledge because of this show. Ricus, here's one for you. For the viewer's daughter that is aged 22. I've been spreading my shares between US Tech, the Magnificent Seven, mix of China Tech, some SA Inc., all nice 40% up on average. I'm now buying a property. Should I take this all out and lower my little bond, or try and keep and adding on these shares while also paying the bond? Ricus?
The first suggestion I have is go and see a financial advisor, because that really is a question that must be constructed for the individual itself. But just from, my very focused stock market perspective, being concentrated in Chinese and American tech is the only thing you've got there is a geographic diversification. You certainly don't have a diversification as far as sector is concerned, and considering the run that it's had, not saying it's not going to continue, but it's not cheap anymore. So I would first of all think about, should I only be in US and China tech? I know the SA Inc. story is is obviously a different opinion. I think probably fine, again, depending on how much you've allocated to that sector. But frankly, if you've got offshore investments and they are concentrated in tech, I would start maybe diversifying into other sectors. Whether one should sell some and pay off the bond, I would really suggest go and see your local financial advisor and take a look at what the best solution is going to be. Although in principle, paying off a bond is obviously quicker, is a far better decision than to delay those payments.
All right, I hear you on that. Well, gents, let us get to your stock picks for today. Chain, what are you hanging your hat on?
Wayne, look, I'm going for Standard Bank. We've really spoken about it, and it's more to do with the rating. I mean, Absa's at a very low rating, and maybe that's justified. FirstRand is at a higher rating. But Standard Bank and Nedbank, they're sitting here at 8-9 PE ratios, which is very, very low for these banks. So I think there could still be a good, 15 or 20% upside just on the re-rating. Earnings won't be great, but I think there is still more opportunity for these shares to re-rate.
Yeah. Ricus, on your side?
I promise I will do local shares one of these days, but for the moment, I'm still sticking offshore. The company is called Lowe's and Company. They are the second biggest home improver business in the world. So they are in America. The narrative I've got there is that with the drop in interest rates in the US, and also if you take a look at US inventory in housing, both newly built and older buildings, there's a stasis at the moment where the property market in the US is almost frozen. Now, the average home in the US is about 40 years old, but what the drop in interest rates has done, it's made it more affordable for your prospective buyer to go and start fishing in this basically stocking of both new and older homes. The moment that turnover starts happening and the US markets, buying and selling resumes in the US property market, that's incredibly good for home improvers, because you buy a house, you want to improve or you want to change. And that home improvement industry has been in the doldrums, and I think Lowe's is very attractively priced, both because of its size and just on a value perspective as well.
All right. Well, thank you so much for your time and for your analysis today, gents. That is all for tonight's Stock Watch. Thanks to our guest, Ricus Reeders from PSG Hole in Ruimsig, and Wayne McCurrie from FNB Wealth and Investments. Up next, the close. Stay tuned.